Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro.
Hello, fellow investors. Welcome to Seven Bulls, a WeGrow affiliate. Today we're back into the world of index funds, specifically the S&P 500. You've probably heard it's a great way to invest for the long haul, but what if I told you there might be a hidden risk lurking? Let's talk about index fund concentration and why the S&P's recent success story might have a twist. Before we move on with the video, if you could give it a like and share, it helps us with the algorithm. Thank you. Now back to the video. The S&P 500 tracks the performance of the largest publicly traded companies in the U.S. It's been a fantastic performer, but lately, a group of tech giants nicknamed the Magnificent Seven have been leading the charge. These companies, like Nvidia, Apple, Amazon, and Microsoft, have seen explosive growth, propelling the S&P to new highs. But here's the catch. The S&P 500 is a market cap weighted index. That means the bigger a company's market value, the more weight it has in the index. So, the success of the Magnificent Seven gives them a much bigger influence on the overall S&P's performance than smaller companies. This is called index fund concentration. This concentration might seem like a good thing, but it can be risky. Why? Because if the Magnificent Seven stumble, or if their valuations get too high and they can't sustain their growth, the entire S&P could take a hit. It's like putting all your eggs in one basket, a very tech-heavy basket. So, what does this mean for you, the investor? While the S&P is still a great long-term investment, this concentration adds an extra layer of risk. It means you're more exposed to the fortunes of just a few companies. On a side note, I personally like to use the company Berkshire Hathaway the same way some investors invest in the S&P. You can't have a better fund manager than the Oracle himself. Some of the best companies in the S&P, without the risk of fund managers chasing the dragon. To mitigate the potential risk, diversification is key. Consider looking beyond the S&P. Explore other index funds that focus on different sectors or regions. You could also invest in small cap or value stocks to spread your bets. Don't get me wrong, the S&P 500 is a powerful tool. But remember, no investment is risk-free. By understanding index fund concentration, you can make better decisions and build a more balanced portfolio for the long run. Hit that like button if you learned something new about index funds. And let me know in the comments below, what are your thoughts on index fund concentration? Until next time, keep up with your financial education. You're the only one in charge of your future. Be safe.
We grew.